Hello, good afternoon, everybody. I hope you're having a good afternoon. So today is 24th, today is 25th of November. So our webinar for today is going to be one very good one. We'll learn one thing which I normally practice personally, but then I've not looked at it, or even if I've looked at it, I've not looked at it intensively, as I want to look at it now. So disregard. This is just an empty screen. We just have a chart. There is nothing else. You can see that I can be able to move, but we do have connection. We don't have any connection because we are doing like an offline recording, so that we are able to explain exactly whatever is happening clearly, so that you see and understand what we are saying. So the first thing, the first indicator, which if you are trading an intraday traders are those that are entering trades during the day. They enter trades maybe in the morning by 7, and then the trade may last maybe for some 1 hour, 2 hours, 3 hours, or some seconds, or even some minutes before they exit the trade. So these are my set of indicators, the one which I use for daily trading. These are the set of indicators which I normally refer to anytime I'm trading. They're the set of indicators which I look at anytime I'm doing intraday trading. These are the indicators which I look at. So the first one is the one on my screen. The first indicator which I normally look at is the one on my screen. This is known as the Zigzag Indicator. This is a standard indicator, which means it comes by default with MT4. And how I use it is this. I use it to set stop losses. I basically use it to set stop losses because I realize that somebody may know how to trade very well, but if you don't know how to set your stop losses correctly, you don't know anything. You must learn how to put your stop losses correctly. So I do place my stop losses based on this indicator, based on the Zigzag Indicator. This is the first thing. For example, when you see this peak, then the price goes down. There's another bottom, inverted peak. This is the bottom, and this is the top. So whenever, assuming you're buying a break above the top and selling a break below the bottom, that is, if the price goes above this top, you pick a buy. If the price breaks below the bottom, you pick a sell. If you are doing such kind of trading, which means you could have taken a buy here when the price went up, you could have taken a buy. My stop loss, I fix it below 1.29383. Does that make sense? So I'll take the trade correctly. I'll basically pick a trade when the price breaks above this high. I'll pick that buy position. I'll have my stop loss below this level. So the lot size which I'm entering here is actually based on the number of pips from this point up to this point, and also the amount of risk, that's the amount of money which I expect to be risking in my trade. Does that make sense? So when the price breaks above, I'll pick a buy. My stop loss is set below this level. Another thing, assuming I'm selling a break below, like in this case there's a bottom here, then the price has gone below. So when I pick a sell here, I have my stop loss at the top, at the high. So this looks like it's really wide. This is a lot of money that if somebody is risking a trade can be very, very much. This one, this is like around 158 pips. So don't worry about this number of pips. The idea is to have your stop loss placed correctly. That's the most important thing. Have your stop loss placed correctly. So have your stop loss, set your stop losses. If you sell it here after the breakout, your stop loss should be below. Should be above this high, above 159.8. So to ensure that you're not risking much, that is because this distance is very wide, the stop loss, the lot size, which is this, should be based on the distance between where you've entered here and where the stop loss, which is at 158 pips. So the stop loss is based on the amount of money we expect to risk in a trade, and also the number of pips that we expect to be losing. So if you expect to be losing like 5% of your account, combine that. You remember in the previous webinar, the one where we looked at how to calculate your lot size correctly, we mentioned clearly that if you want to calculate your lot sizes correctly, you must do a combination. Don't just calculate your lot size based on the amount of money you expect to get in a trade. No, you calculate your lot sizes based on the amount of risk involved. So if you expect to risk maybe 50%, I mean 10% your account, the number of pips for loss is around maybe 159. Use that combination to come up with the lot size. So the formula for lot size is you divide. I'll put that down for us so that you're able to see what I'm saying. Lots is equal to, sorry, so lots is equal to risk. This risk is the amount of money which you expect to risk in any given trade. So if you enter a trade now, the amount of money which you expect to be risking is known as the risk. Then the next thing, you divide that by stop loss in pips, stop loss in pips times value per pip for that currency or that symbol. Value per pip. So this is the formula. This is the correct formula that anytime you are doing intraday trading, you need to have this at hand. Do not just be risking a fixed amount of money in your accounts. Like if you have, maybe you have 500 USD in your account, do not just risk, do not keep risking just maybe $50 or maybe $20 in every trade. No. First of all, get the distance. Every time you enter a trade, get the distance between the point of entry and the stop loss. Then also get value per pip. Value per pip is, you learned that at the time. I think we had an indicator which we developed the previous time, the one which was calculating the value per pip. But for the British pound, the value per pip is 10 USD. So this is the percent of your account you're putting at risk, this risk. Divide that by stop loss in pips, which is the distance between the point of entry and the stop loss itself. And then this is the value per pip, which in this case is 10. So this is how you come up with the losses. Do not just calculate losses anyhow. Don't just come up with some rough number and then you name them as the losses. No. You have to do serious calculation. For another example, like in this case, when the price goes above this top here, I will basically place my stop loss below this low. So you can see that the difference between this point of entry and this is different. This is 22 pips. The other one is how much? Is 158 pips. So when you're doing the lot size for this distance, the lot size is likely going to be bigger compared to the lot size when you're entering a sell at this point. Are we on the same page? You should understand this properly, because this is one thing where most people go wrong. Most people understand, they have very good strategy, they know how to trade, but they don't know how to calculate their lot sizes correctly. They don't know how to come up with their lot sizes correctly. So this is how I do that. This is how I set my intraday trades. This is one indicator which comes really handy when you're doing intraday trading. Like in this case, we have this top, the price has broken above, so we pick a buy. Our stop loss is fixed here. The lot size which we are using is based on the distance between the point of entry and the stop loss and the percent of the account that we put at risk. That's another example. We also have another one here. So this is a bottom, this is a break below. So this is a sell here, then there's a stop loss at the top here. So as I've said, I'll enter the sell here, have my stop loss, and then have my take profit, maybe 50%, 90%, or maybe 100% move. So that depends on the person trading, but how to calculate your risk is what I'm mentioning now. Is this clear? This is one very, very useful indicator. This is what I normally use. I have to have it. In any of my charts, you'll see that I have to include this indicator. Okay, the other indicator which looks really important, which it's also very, very good, is known as the ADX indicator, the Average Directional Movement Index indicator. So that indicator, how you get it, give me a second. This is how you get the indicator. You go to file, and then it's a trend indicator here. The first one, average directional movement index. Then you can see that it has some line here. It has two lines. There's the green one, yellow green one. So I'll make this green, not yellow green, and then I'll make the next one red, so that we differentiate between sells and buys easily. Okay, that's how it looks. Let me expand them. Like that. Okay, so if you look at this chart now, if you look at my chart, you can see that this indicator, we have this indicator, we also have the next one. So how I use this two is this. The last one, the index indicator will explain it. It has three lines. This is the first one. This one, the one at the top. The color normally is light green. The color is light green. And then we have the next one, which is green. And then you have the next one, which is red. So all these, they stand for something. Then on the right hand side, there are the levels for this indicator. There's 49, there's 37, there's 35, and then there is 13. We have 1. So amongst these levels, the most important level is actually 25. The most important level in this case is actually 25 level, the level 25. I'm going to explain why that is important. Levels, just a second, add 25, and then give it a different appearance, like that, then you close. So this is important because it's used in relation to this line. So we saw that this line is not blue. It is, the color of this line is light sea green. Let's make it blue so that it's different from the others completely. Yes, so the blue line, the one you're seeing, it is the one which we use in relation to this line, the level 25. The blue line is the line which we use in relation to this line. So as long as the blue line is above the level 25, that means we are upwards. As long as the blue line is above the level 25, that means we have a trend. Sorry, it does not mean we are upwards. It basically means we are in a trend. There's an active trend. So like on this instance, you can see this from this point, the blue line is above. It meant there was a trend. Also the trend continued. There was still a trend. There's still an active trend, and then the trend dies, and then there's no trend. Then there's a trend here, there's trend, there is no trend, then there is an active trend before it subsides. Then here there is no trend. So anytime you have the blue line above the 25 level, that means there is a trend. That means there's a trend. Anytime you have the blue line above the level 25, that means we have a trend. Now the question is, which trend is that? Because there are two types of trend. There's the uptrend, there's the downtrend. So what tells you the trend which you're having is actually the green line or the red one. If we have the blue line above 25 and the green one above, you have the blue line above 25 and the green line is above the red one, that means how you interpret this section. Let me highlight that area so that you see what I'm saying. If you have something like this, you have the blue line above the red line, the blue line above 25, and then the green line above 25. So the blue line means we have a trend. The green line now means that trend is actually upwards. So that's how you interpret this section. The opposite is true for this one. So opposite in relation to the green and the blue line and the red line. So you have this one above 25, the blue line above 25, which means there's a trend. The red line is above the green one. That means we have a trend. Yes, that trend is downwards. Does that make sense? Does that make sense for you? I hope that makes a lot of sense. That should make a lot of sense. So you have the blue line. Anytime you have the blue line above 25, that means we have an active trend. Then the green line being above the red one means that trend is upwards. So when you have the blue line above the red, the 25, and the red line above the green one, that means we have a trend, and that trend is downwards. Does that make any sense for you? It should make a lot of sense. It should make a lot of sense. So whenever you're trading anything, maybe you're selling based on this low and this close below, ensure that you have something which helps you understand the trend. Add one more indicator. So like in my case, I use this indicator, I use the ADX, I use the zigzag indicator, and then I use a combination of two moving averages. So the first moving average, the one I use most, I use them mostly on lesser time frame, maybe 15 minutes, sometimes 5 minutes. So how I use them is this: the moving averages. We have here trend, moving average. There is the 30 simple, apply to close. This is the first moving average here, and then we have the next moving average, which is 200. So in this case, I basically trade across between the two. I trade across between the two indicators. So if the 200 moving average goes below the 30 moving average, that means we are upwards. So any position I look at in that chart has to be upwards. And anytime the 200 moving average rise above the 30 moving average, that means we have a downtrend. So that in that case, I look for a sell position. So if you have something like this, if you have something like this, you have the black line above the red one, like in this case, this is uptrend. So you wait for a break above these tops. That's when you look for buy positions. If you trade like that, if you keep looking for positions when this is true, you'll always find that you are correct. So that means you could have bought a lot of things here. The same thing here, you could have, this is like a very good uptrend. So it helps you weed out these multiple signals, the ones you're seeing here. Sometimes it's down, sometimes it's up. It helps you weed out all this noise, the one you're seeing at the bottom of the screen. Is that clear, whatever I'm saying? So those are some of the few indicators that I trade normally. I use during the intraday trading. Of course, there are tons of other indicators, some which are really good. We have here, this is another one which is also very important, the Bollinger Bands. It's really useful. I use it a lot also, but not often. Then I also use Ichimoku Kinko, that's the name. And then I use also parabolic SAR. So these are the indicators I use. I use this, the moving average, mostly. I use the average directional movement index, mostly. I use Bollinger Bands, mostly. I use parabolic SAR, mostly. And I also use this. So if you want to trade correctly, you may want to learn about the oscillators. The oscillators basically shows you the levels that are overbought in the market and the levels that are oversold. All these are those oscillators. Then there is the volume indicator. They show you the volume. Then we have also Bill Williams. So you can learn how to use all this. You only need to go to help. Then there is this help topics. Then you can search about any indicator which you feel you need to understand about. Get the information here. Or if you don't know how to use the MT4 itself, you can just move here. Look, there's very serious explanation about how this indicator works and even how they were created. Does that make sense? So these are some of the few things that people need to understand. If you're a trader, you need to understand how to get help, how to get more about indicators, learn more about this indicator. So we're going to create like one webinar which help everyone understand how to navigate the MT4 itself, so that you're able to know where things are. If you see an indicator, a standard indicator which you don't understand, you know where to get the help. You'll know where to get the help from. We'll do a webinar which explains just that. So thank you very much. That should bring us to the end of today's session. We'll meet again next week at the same time. So thank you. See you.